Today is Friday, May 10th, and this is the ADM Investor Services Weekly Market Wrap-Up. The thoughts and opinions contained in this video are solely those of our guests and should not be construed as the thoughts or opinions of ADM Investor Services or Archer Daniels Midland Company. Our guests today are Steve Freed, the Vice President of Research at ADMIS, and Alan Bush, ADMIS's Senior Financial Economist. Steve, about an hour ago we had a USDA grain report. Can you share your takeaways from that report?
USDA did exactly what the market thought they were going to do. They raised the demand for U.S. soybeans both this year's marketing year and next year, lowered the carryout. Initially, the soybean markets rallied as much as 17 cents. Now we're up about 10 cents. They also raised corn export demand because of the lower Brazil corn crop, lowered the carryout. Corn was up about 6 to 7 cents. Now it's down about a penny. And the wheat, they raised the wheat crop here in the United States. They also raised the carryout. Wheat's been down about 10 cents. I think the key to this is they did exactly what we thought they were going to do. Now we're going to trade weather.
So soybeans, corn, and wheat took out recent highs this week. So did crude oil. The funds are adding to long positions, but we've got good U.S. weather and adequate world supply. So what's going on in there?
I think there's a lot of trading on perception. There continues to be some forecasts that July and August U.S. weather is going to be warmer and drier than normal. Now, that most of the heat might stay in the southern plains, but it may not be the perfect weather for what's going on as far as crop production is concerned. I also think that the grains are trading unbelievable soybean demand. From October through March, we're going to see demand for U.S. soybeans that we've never ever seen before. So even with good weather, there are some economists that believe soybean prices will continue to rise on this record demand.
So speaking of soybean demand, Brazil has lowered its estimate of the 2016 corn and probably more importantly soybean crop this week. Will this help the U.S. exports as well?
Yeah, I think that the USDA is still underestimating what the total demand is going to be for beans. They came out and we think that we could ship 2 billion bushels of beans in the 2016-17 campaign. There's already talk that for October, November, December, that the export capacity of the Gulf has been sold out, and you're seeing shuttle trains being sold to the P&W, and that for October, the Pacific Northwest export capacity may also be sold out. And then we're also noticing that the Chinese are coming in and buying soybeans every day. Every day we see new crop sales. Today there was old crop sales sold to China for soybeans. So it's a combination of the lower South American crop, and I think the soybean demand from China is going to be a little better than what the USDA is saying. It's going to have us record demand for beans in 16 and 17.
All good for the U.S. farmer.
It's all good for the U.S. farmer. I think that, again, we're going to have to try to balance the weather. It's going to rain next week in the Midwest. So, if you're a trader, you almost want to sell this rally today and then buy next week if it goes down because of the rain.
Alan, during most of the month, the Federal Reserve officials talked about the strengthening economy and the need for at least 2 additional Fed hikes this year, with the first one possibly taking place this month in the June meeting. Now, however, the financial futures are showing a low probability of a near-term increase and perhaps just one increase later in the year, maybe fourth quarter. What happened between last month and now?
Okay, what happened was very dramatic. We had a non-farm payrolls report that was the worst in 6 years, coming in only up 38,000. The guess was up for 160,000. So the economy is not as good as what many Fed officials apparently had thought. So it does look like they are backing away from their aggressive and hawkish interest rate market stance. So the probability of a rate increase at the 15th meeting, the 15th of June, is only 4%. It's 29% at the July meeting and at 59% for the December meeting. So it looks like we will see a rate increase, but not till the end of this year.
And looking at the stock sale, this week's S&P 500 futures advanced to new highs for the year, and again, close to the all-time highs. What is your outlook for stock index futures right now?
Okay, well, we did see new highs for the year in the S&P on Wednesday. Since then, we have backed off over the last couple of days and some hard declines today. And it looks like some of this pressure may be linked to the possibility that the UK might leave the European Union with that referendum on June 23rd. So uncertainty often means lower prices, and I think that's exactly what is taking stock indices lower now. Once the referendum is out of the way, whether they decide to leave or to stay in the European Union, that I think a new leg up will ensue for the indices. I think we'll see some new highs for the year in the S&P after the referendum.
Do you have a personal opinion on the referendum in the UK and whether the vote will be yes or no?
I'm more inclined to think that they will vote to leave. And one reason I think that is today, the pound is substantially lower, about 150 points lower on no news. So I think the value of the pound can be used as a proxy as far as what the polls are likely to show or are showing. So the Leave faction apparently has the upper hand right now, and I think there's a growing possibility that they will vote to leave the European Union.
Some say if the UK leaves the European Union, it'll be have a drastic effect on the rest of Europe.
I think it is likely to have a minimal negative impact. I think we're seeing a lot of political commentary and scaremongering, so to speak, of what could happen if the UK does leave. I think in the short run, it might be just a small negative. In the long run, I think it's a very big positive for the UK.
Steve, natural gas is up on talk that the summer weather could increase demand. Do you feel this is justified?
I think so. I mean, I think that our weather forecast is for warm and dry conditions, so I think that you'll see generator demand go up, and that's going to increase the demand for natural gas.
There's been higher than expected Chinese commodity imports of late, as you mentioned, led by crude oil. Another sign that maybe the Chinese economy has bottomed. What are your thoughts on that?
I think when you're dealing with China, it's important to watch what they do, not what they say. And I think that this import demand lifted the markets one day on inflation concerns. We saw crude trade over $51. We saw copper rally. We saw silver rally. And then we had all this other information coming from Europe. And then you had some concern about recession globally. So some of those markets have backed up. But I think the China economy, as Alan has said before, has bottomed. And I think they're slowly going to start moving higher, which is positive to the commodity prices.
Ellen, speaking of commodity prices, what's your current outlook for gold? Some analysts feel the market is topped. You don't necessarily agree.
No, I do not agree with that at all. In fact, some of the bears on the market are citing 2015 gold production figures as a negative, when in fact, of course, that is true. We did have record gold production last year, but in the subsequent years, this year and over the next 4 or 5 years, gold production is expected to decline. So from a supply point of view, we think that gold is headed higher. From an inflation point of view, we feel the same. Inflation is coming back rather slowly, but it has turned a corner. So the gold market is likely to advance, and we have a long-term objective that I think we could possibly see next year at 1467, and that is based on the midway chart congestion pattern of predicting objectives.
And finally, what's hot? What should traders be watching right now?
Well, I think that copper is one in the market that you have record shorts in the marketplace. You have Singapore stocks declining. And if the Chinese economy is bottoming and moving higher, copper is one market that you probably should look at from the long side. As far as the grains are concerned, I think the next 30 days is going to be extremely volatile. A very good trading environment. Selling the rain and buying the dry weather. But I think the soybean market is a market that eventually will be hot. If we look at the demand figures, either after the growing season or in that first quarter of 2017, soybean prices should be trading at $13 a bushel.
Remember, the thoughts and opinions contained in this video are solely those of our guests and should not be construed as the thoughts or opinions of ADM Investor Services or Archer Daniels Midland Company. If you have any questions or would like to learn more about ADMIS's brokerage and risk management services, please visit www.admis.com.